Welcome to the Business Short Course Series presented by the Iowa State University Extension and Outreach Farm, Food, and Enterprise Development Program. This course is an introduction to financial projections. Financial projections are estimates of a business's future revenue, expenses, and profitability. They're a powerful planning tool that helps businesses set goals, plan strategically, and attract investors. They matter because they do a lot more than just forecast numbers. They help secure funding, guide important decisions, highlight financial risks, and provide a way to measure performance over time. When building financial projections, there are 5 key components to include: a revenue forecast. This is your best estimate of future sales based on market research and trends. An expense forecast, where you project both fixed costs, like rent or salaries, and variable costs, like materials or shipping. A profit and loss statement, also called the P&L. This shows your expected net income over a specific period based on your revenue and expenses. A cash flow statement, which tracks the expected movement of cash in and out of your business, helping ensure you have enough cash on hand to operate. And finally, the balance sheet projects your assets, liabilities, and equity to give a snapshot of your business's financial position in the future. Creating financial projections involves a step-by-step process. We start by gathering data. This means pulling past financials and conducting market research. Next, we make assumptions about things like sales, growth, pricing, and costs. These assumptions set the foundation for your forecast. Then we create revenue projections, estimating how much we expect to sell and at what price. We follow that with estimating expenses, both fixed and variable, to understand the full cost picture. From there, we develop full financial statements, including the profit and loss, cash flow, and balance sheet projections. Finally, we review and revise regularly. Projections are living documents. They need to reflect current conditions and actual performance. Here's a simple example of straight line forecasting in action. Let's say a company has been growing steadily at 5% each year. If their current revenue is $500,000, and we expect that same 5% growth to continue, then we can forecast next year's revenue by multiplying 500,000 times 1.05 equals $525,000. This method works well when a business has consistent historical data and predictable growth patterns, as shown in the linear trend on the left. Now let's look at another forecasting method, the moving average. In this example, a retail store wants to forecast sales for April using a 3-month moving average. We take the past 3 months of sales, January $30,000, February $28,000, and March $32,000, and to calculate the forecast, we add those together and divide by 3. So, the April sales forecast is $30,000. This method smooths out fluctuations and is useful when sales don't follow a strong upward or downward trend. Let's walk through a basic financial projection. In this example, we're starting with last year's revenue figures. We're applying 3 assumptions. Number 1, a 50% increase in marketing will boost sales by 20%. Number 2, repair revenue will increase by 5% due to inflation. And number 3, all other expenses will increase by 4%. The last year column shows actual figures, while the next year column reflects our projections after applying these percentage changes, shown in the far right column. At the bottom, we can see the impact of these projections, a 37% increase in net income. As you build financial projections, it's important to watch out for some common mistakes. First, avoid overly optimistic projections. It's easy to be hopeful, but forecasts should be grounded in realistic expectations based on data. Second, don't neglect cash flow. Just because a business shows a profit doesn't mean it has cash in the bank. Always track liquidity. Third, build in contingency plans. Businesses face surprises, unexpected costs, slow seasons, or market shifts, so it's wise to plan ahead. And finally, avoid generic assumptions. Every industry and market is different, so tailor your projections to reflect your unique situation. As you build your financial projections, there are several tools that can make the process easier and more accurate. Spreadsheets, like Excel and Google Sheets, are great for building customized forecasts using templates and formulas. Accounting software such as QuickBooks or Xero can automate some of the forecasting process and pull data directly from your books. And don't forget about industry reports. Trade associations and government publications can give you benchmarks and trends to help ground your projections in reality. Let's test what we've covered so far with a short quiz. Question 1. What are the key components of financial projections? A, a profit and loss statement, B, a balance sheet, C, a cash flow statement, or D, all of the above? Question 2, which of these is a common pitfall of financial projections? Is it A, math error, B, expenses decrease, C, being overly optimistic, or D, the results are unknown? Question 3, financial projections are always accurate. Is this true or false? If you need extra time to determine each answer, feel free to pause the video now. We'll show the answers in just a few seconds. Here are the answers. For the first question, what are the key components of projections? The correct answer is D, all of the above. The profit and loss statement, the balance sheet, and the cash flow statement all play a role in telling the full financial story. The answer to question 2 is C. A common pitfall when creating financial projections is being overly optimistic. And finally, the answer to question 3 is false. Financial projections are based on assumptions and best guesses, so they will not always be accurate. As a result, projections need to be adjusted regularly to account for new information. As we wrap up, here are a few final takeaways to keep in mind. First, financial projections are essential for planning and growing your business. They give you a roadmap and help you stay focused. Second, projections help attract investors and secure funding, showing that your business is prepared and has a vision for the future. Third, keep your projections updated. As your business evolves, your numbers should too. Use real performance data to adjust your outlook. Finally, leverage the tools and resources available to you, from spreadsheets to accounting software and industry reports, to ensure your projections are accurate and informed. Thank you for listening to this presentation brought to you by the Iowa State University Extension and Outreach Farm, Food, and Enterprise Development Program. We're here to help you make informed and confident decisions for your business.